Thank you, Mr. Chairman. I thank our witnesses. At the signing ceremony for the Dodd-Frank bill in July of 2010, President Obama proclaimed, and I quote, "Unless your business model depends on cutting corners or bilking your customers, you've got nothing to fear from reform," end quote. Unfortunately, the bill the President signed that day did nothing to reform the two entities that cut the most corners, bilked taxpayers out of billions of dollars, and were more responsible than anybody or institution for the financial crisis of 2008. I'm, of course, referring to Fannie Mae and Freddie Mac, the government mortgage giants that for years worked to drive down underwriting standards and increase borrower leverage in the housing market, all under the guise, I believe, of promoting home ownership. These policies created an enormous housing bubble which inevitably crashed and in the process hurt the very families, real families, that were supposed to be helped and instead stuck the taxpayers with the bailout bill. As our committee works to bring real and lasting reform to the housing market, I hope that today's hearings serve as a vivid reminder of where misguided government policies have gotten us in the past. I thank you, Mr. Chairman, for this hearing. I thank our witnesses for being here today, and I yield back my time.
Gentlelady.
Thank you very much. I thank the gentleman from Alabama for yielding his time. Mr. Wagner, one of the things we've heard from Fannie and Freddie defenders since the crisis is that the GSEs were basically innocent bystanders as underwriting standards deteriorated over the last couple decades, and that in the mid-2000s they were only trying to, quote, catch up with what the private sector was doing. I know in your book, which we've spoken about, Reckless Endangerment, you seem to refute that argument, saying that in the prologue, Fannie Mae led the way in relaxing loan underwriting standards, a shift that was quickly followed by private lenders. Then in Chapter 4, you describe Fannie Mae's 1994 $1 trillion commitment to be spent on affordable housing goals. This was 14 years before the financial crisis and way before anyone had ever heard of Ninja or Alt-A or no-doc loans. I'm just wondering, what came first here, the chicken or the egg? Were Fannie and Freddie the ones that led the charge to decrease underwriting standards, or were they innocent bystanders as things went haywire?
Well, as you point out, they did lead the charge, and frankly, it's not just the easing of underwriting standards. I think it's very important to remember that it's easing of underwriting standards and reductions of down payments. And that's critically important because the foreclosure rates would be significantly lower nationally if people had equity in their homes as home prices were falling. And the GSEs, again, led the way to lower down payments. In fact, the subprime industry, I was on the sell side in this space for the 90s, and there was a subprime industry. It disappeared in 98 and 99 because of the Russian debt crisis, but at that point, subprime was defined by the borrower, not by the product, and for the most part, the borrower was self-employed, had a ding in their credit history, but they were required to bring more equity to the table in terms of a down payment to get the mortgage. And so it really was the GSEs seasoning the market. It really was the GSEs making the rest of the market comfortable with concepts of lower down payments, eased underwriting standards, lending to borrowers who historically would not have met underwriting standards. Remember, Beneficial and Household, two of the original subprime lenders in this country, which existed since the 1950s, were subprime lenders to non-traditional borrowers, but again, required significant amount of equities be brought to the table on those products. We ended up with the GSEs offering low down payment loans to lower and lower quality borrowers.
And let me ask you on that point, can you trace these activities of the GSEs back to the 1992 Act that created affordable housing goals for the GSEs?
Yeah, I mean, there's absolutely a piece of it that goes back to the '92 Act in terms of affordable, in terms of the goals, but also in terms of the safety and soundness problems, and in terms of the cronyism that ultimately led to this. Right? It's not again, it's not even just the GSEs per se in terms of the role as a provider of liquidity, not excess liquidity, liquidity to the secondary mortgage market. It's the special ties to government that created all of the perversions that ensued.
You know, we had Ed Pinto here from AEI who spoke with us past week, and he noted in a post-crisis study that in 1990, 1 in 200 mortgages in the United States had down payments of less than 3%. In 99, that number was 1 in 10. And by 2006, that number was 1 in 2.5. Down payments of 3%, that's a dramatic increase in borrowing throughout the financial system. What role did GSEs play in increasing borrower leverage, and how did that cause or exacerbate this crisis? And I know our time is limited.
Well, again, the GSEs did lead the way in lowering down payments. That was one of the concerns that I really highlighted in the 2001 Home Without Equity is a rental with debt report. And one of the reasons that it became clear that we were going for an increasing leveraged system. And while that posed opportunities for growth well in excess of GDP, it ultimately would come at the risk of a vicious spiral downward in home prices on the other side.
I thank you very much.
I thank you, the gentlelady. Yields back.